Thank you. Thank you very much. I really enjoyed the paper. Paper by Chama and Fabian Valencia is, I think, a really nice paper. I learned a lot from it. And then especially because I come from the, there are also a lot of our member countries that will also benefited from this, the lessons I've learned from this paper. So let me begin by restating the motivation of the paper. The paper was basically motivated by the fact that oil price volatility, in particular, drop in oil price between 2014 and 2016, has promoted or re-promoted interest to design a strategy to manage risk. So the drawing from Mexico experience, analyze potential welfare gain from hedging the oil price risk, specifically. It focuses on the role of hedging instrument to complement defaultable debt, a hedging strategy. And the paper shows that the welfare gain from hedging, in this case, in the presence of defaultable debt in particular, is positive, and most of the gains coming due to lower spreads that reduce the cost of borrowing. The approach taken by the paper, basically a dynamic optimization model used by Borenstein in this paper 2013, by a standard sovereign default model with access and is calibrated to mimic the Mexican data. The benchmark economy basically exposed risk of its oil exports and can go through multiple debt acquired by risk-neutral foreign investors. The model is then solved under perspective of benevolent government who will maximize its welfare. In this case, welfare is measured by the increase in consumption, permanent. The gains from hedging are quantified by comparing the welfare gains in terms of a permanent increase in consumption between the baseline model, is with the access to put options, and the one without access to it. Findings are interesting, and when the economy has less wealth, its probability of default is high, and hence gains from hedging will be small. But as wealth increases, the economy becomes less indebted, probability of debt of default then declines more, but which is more quick in an economy with hedging compared to the one without hedging. Welfare gain out of conducting hedging declines as wealth increases because hedging itself is costly and the default become less relevant as countries get more wealthy, gets wealthier. So result from a lower benefit of a reduction cost in borrowing. Conditional welfare gains basically vary for permanent increase in consumption. When it's computed in terms of unconditional welfare gain, it is equivalent to a permanent increase in annual consumption of 0.44%. Maximum value of the conditional welfare gain computed earlier, mentioned earlier. The lower cost, there's a mistake there. Lower default for probability, basically as a result of hedging, will lower cost of borrowing and increase that ratio. And because of that, the hedging economy can then manage to sustain higher level of consumption despite the cost of the put options it has to pay. The other interesting findings I found from the paper are that there are several interesting ones coming out of the sensitivity analysis later in basically of the paper. whereas welfare gains tends to be relatively sensitive to changes in hedge portion of oil production, alpha, risk of default, sigma, and the growth rate of non-oil sector, G, capital G, termed in the paper. The gains in welfare also is going to be higher under a selling forward scheme relative to those the put option scheme that was as a base model, a baseline model in the paper. The difference is about 20% more. With that, I come into some is the main channel through which hedging works to improve welfare is through invoking less uncertainty by means of lowering the range of possible realization of future income, basically income smoothing mechanism, which reduce uncertainty and hence reducing the probability of default in the economy. So with that mechanism at hand, should there be any additional channel that works in order to beef up or affect the benefit from hedging in this case? The other set of questions I have is about the fact that the paper in its conclusion defended hedging through the use of options, despite the simulation suggested that larger welfare gains from selling oil forward is quite obvious. The paper itself argues that it is considering the political economy aspects of options, whereby the government will have the implication of having to give up a potential revenue windfall had the oil price rise. The model is solved under perspective of benevolent government anyway, which maximizes wealth. So, selling oil forward should be a more preferred option than or is it the case because the result is not robust? Discussion on the last one I have coming from the Asian Development Bank. I was wondering transformation to the oil or resource dependent economies. Capital G is to be exogenous. The main mechanism is really through improving, reducing uncertainty, of borrowing, enhanced more liquidity for the economy to finance more activity. So usability from hedging might also have some implication on the dynamics of the non-oil sector. I know it's not going towards that direction, and see how the result look like later. I'll stop there. I really enjoy reading the paper and I learn a lot from it. Thank you very
much. Thank you, Arief. Chang, you have some time to react to the discussion, and then we will take some questions.
Thank you very much, Arief. Very constructive and insightful comments. I have a limited time to quickly react, so forgive me if I say something still a bit. Yeah, one is whether channels through hedging, which our model failed to capture. Yes, so in reality, there will be other channels which hedging can help this economy, but our model fails to capture. In the model, the benefit only have twofold. One is reduce income, in particular oil income volatility. The other one is to change the default incentive, therefore has an impact on the borrowing cost. So these two channels are, which is our model clearly captured. But our model didn't have that's gonna leave some open area for further research, which is that by doing hedging, you can increase your commitment power, because if you imagine in a world your commitment vehicle gonna depend on how volatile your income is, to the extent that macro hedging can smooth your income, therefore that will have an impact on your commitment. And if you can increase your commitment, as a result, increase your policy effectiveness, and that will have a beneficial effect on your domestic economy management. But our model didn't have that aspect. To that extent, our estimation is gonna be a lower bound for hedging. The second one, so you raised the question why we want to say something about the political reasons prevent or mitigate the case of forward over put options. Actually, from the model perspective, it's clear that forwards gonna generate a much larger welfare gains than the put options, simply because it does not incur any upfront cost. When we present these results earlier at the IMF, people have a simple question, which is that if that's the case, why don't we observe in the real world many countries use forwards but choose to use put options? That's the reason we add that discussion of conjectures, why or what reasons prevent forwards to be prevalent. One political reason is political constraints. If you do forward, you have to lock into a predetermined prices. Why do that? It will raise questions from people. Politically, it's very hard to do. So that's our discussion. But you're right. We will we will clarify more in our next version. The last one I think is very interesting: structural reform. We didn't endogenous our non-oil exporters or non-oil sectors. If we do that, I can imagine that if you smooth your oil income to the extent it can help you alleviate the Dutch disease, that's potentially gonna beneficial to these small economies. But I don't know which directions it could go. It's gonna be an interesting exercise to do in the next version. Thank you very much for the insightful comments.
Thank you. We have two questions right now. First one, okay, maybe three. First one from Deepa Datta, Francisco.
Yeah, you've mentioned a little bit about the political economy considerations in comparing options and forwards, but I was wondering whether you had a sense of what are the considerations that might be preventing many countries from implementing these kinds of policies, either both options and forwards, and whether they're sort of also inside or even just outside of your model. Thanks.
Sure. Thank you very much. So I actually have a discussion with Fabien back when I was at IMF. So it's generate lots of debate at the Mexico government whether doing hedging is worthwhile, even though in 2016 the program clearly makes money. Because some politicians just think you are doing waste of money. Why do you pay this price to do the hedging, and derivatives is risky, and Wall Street banks, do they give you a favorable price? So this kind of things can kind of generate lots of questions from the political campaign and the people. So clearly that's that's some political difficulties for put options. Forwards, as I said, it's mainly because of which price you want to lock into, right? So you can say I want to lock. Ideally, you want to lock into some price which historical mean, or you know that in 1 year later you will surely be hedged by the downside risk. But technically, it's very hard to do. Taking into the account, it's very hard to predict oil prices. So both technically and politically, I think it's hard for the forwards. Thank you.
We have a question by Miguel Acosta and one by Juan Pablo Medina.
Okay, Miguel. Yeah, hi Chang. I really like your paper. I have a question. I was thinking that actually the welfare gains may be an upper bound because first, your alpha, if I understood, which is the share of commodities you want to hedge, is exogenous, probably because of the way it was implemented in Mexico. But if you extend the framework to a framework where you choose production of oil and you have to extract reserves, so you have to compete in costs, which is the cost of the option or the cost of extraction. And in that world, I'm not sure. I would think that alpha will become endogenous, and I'm not sure you will get the same hedging in the optimal framework. That's the first part, and the second part is what you said before, right? You're assuming that you're only trading commodities, but if you expand it to all commodity trading, especially when you have small producers that don't have access to margin accounts and so on, just because of these constraints, it would be harder to hedge. So perhaps I was thinking the welfare gains may be an upper bound. I'm not sure.
Yeah. So yes. Thank you very much. That's a very good question. So ideally, we should have a framework that the country can optimally choose the level of alpha, right? So the share of commodities that hedged. If our alpha, so far we calibrate alpha to the data. If we believe Mexico government is smart enough to choose the optimal alpha, or welfare gains gonna give you the upper bound of welfare gains. And but if they're not smart enough, actually, by allowing them to ultimately choose alpha, the gains gonna change, potentially gonna reduce the gain. I agree with that. So it's gonna be interesting to have that generalization. Second, private sector business. Yes, I agree with you. We should have that discussion, but we don't have it now. We will definitely do that.
Thanks.
Sure. Thank you.
We had a question by Juan Pablo Medina.
Juan Pablo?
Okay, can you hear me?
Yes.
Okay. Thank you for the presentation.
Yeah.
I was having a question regarding that there is an alternative way to do the macro hedging. I don't know if it is possible to add in the model like a sovereign fund wealth. So because probably an additional question is to see the comparison regarding that this option of macro hedging is smarter, is intelligent compared to a self-insurance. So maybe you can sharpen your result, showing the result of the welfare gains. It's much bigger in this kind of macro hedging compared to the sovereign wealth fund or not. I don't know. Maybe that could be an angle that you can make a better assessment of how different alternative of macro hedging compare in the result of welfare gains. Thanks.
Yeah, sure. Thank you. Yeah. So far, what we are doing is Mexico doing either put options or self-insurance, which is issue defaultable bond. But you're right, we don't have a separate role sovereign wealth fund. So far, you can imagine sovereign wealth fund is part of the economy. We don't have that separation. We could do that, yeah, to see the robustness of the welfare gains. Yeah, we can have an extension on that dimension.
Okay,
thanks.
Thank you. And we have one final question by Rodrigo Wagner.
Hi. Hola. Can you hear me?
Yes.
Oh, thanks for the presentation. So I have a few, I don't know if suggestions and comments. I think the original the Borenstein paper in the JDE has this trade-off between insurance and insurance and sovereign wealth fund, and actually points out that the more hedge you have, the less you have to self-insure in some way. But the key point, as you suggested, has to do with the price. I mean, the portion, the share that Wall Street pockets of the deal. The second point is we only if you want, we have a paper that makes the point for not for sovereigns but for corporations, that the more commodity corporations are hedged, the cheaper are the yield to maturities of their bonds. So it essentially documents the fact you are getting, but for corporations. But it's a reduced form model, econometric model.
I see.
Then if you want, I can send you the link and so on. But it goes to.
I was about to say.
We observe that in practice.
Paper.
Sure. I have it here. And a third point, I just wrote a piece on precisely the comparison of the Mexican hedging against the Chilean forward in the 2000s. So you are exactly in the right virtual place, because Chile tried Chile tried a forward and was tremendously unpopular, because we signed a contract with the Chinese government, with the Chinese state-owned company, and we lose like a couple of $1 billion. So, and I'm actually writing down that in case you want. I mean, there is a whole political economy story, and one central point then, because beyond the self-promotion, here goes like a serious question. Something we found is that in this discussion, Mexico against Chile in the type of hedging, it was that the Mexican deal was a yearly deal, because you could buy every year the put option, while in contrast the forward deal, which was, by the way, a very bad deal, but was also a long-term deal, like a 15-year deal. And so my central question is, do you have a consideration of the timing of the hedge? Because you would like to hedge long-term oil risk from a welfare perspective, but the market offers you normally like short-term deals at a reasonable price, and long-term deals are God knows what. That's my central question. Okay, do you have anything about the timing?
Yeah, so for me, I don't have any timing issues in the current model. I'm comparing 1 year forward with 1 year put options, so I can compare a multiple year forward with 1 year put options to match the experience of Chile and Mexico, and just do some comparison analysis. Yeah, we can try that and see how much it will change the results I got now. But I think I like your comments on these additional real-world observations. If you don't mind, could you please send me the references? I'd like to take a look.
Of course. Yeah.
Thanks. Thank you very much. Very helpful.